The Fed, inflation, and war in Ukraine all coming together. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the Fed playing a tough hand.
I think they're recognizing that they're behind the curve. I think they've still got a long way to go.
And Rick Rieder of BlackRock on a Federal Reserve dealing with multiple crises close to the zero bound. This week, we had it all. A continuing war in Ukraine, with Ukraine President Zelensky addressing Congress and President Biden.
President Biden, you are the leader of the nation, of your great nation. I wish you to be the leader of the world. Being the leader of the world means to be the leader of peace.
As President Biden plans a trip to Europe next week to consult with allies.
The White House announcing President Biden is going to travel to Brussels next week to meet with NATO allies as Russia presses on with its invasion of Ukraine.
With more Russian sanctions on the table.
We have to seriously consider which mean puts pressure on Putin and which mean could harm ourselves more.
Oil shot up to over $130 a barrel, only to plunge below $100.
If you have access to a chart intraday of Brent crude, pull it up right now. 97 handle on Brent, then take it back a week or so. We've got a $40 plus swing on crude on Brent. Tom, in a week, one single week, $40 swing.
All of which were important to investors, but none as important as the Federal Reserve decision on Wednesday. When it made it official, we're moving from monetary loosening to monetary tightening.
Every meeting is a live meeting, and we're going to be looking at evolving conditions.
I think that the Fed has largely abandoned monetary orthodoxy. It's trying to be too cute in how it's managing this.
Whether cute or not, markets took what the Fed had to say in stride, with stocks rising again on Friday, capping a risk-on week, with the S&P 500 up over 6%. That is the best week since November of 2020. And tech did even better, with NASDAQ higher by 8%, while bond yields, after shooting up briefly with the Fed's announcement on Wednesday, settled back down to 2.14 on the 10-year by the end of the week. Up a bit, but not that much. In the meantime, oil, after all those fluctuations, ended up with Brent around 107. To take us through this volatile week, we welcome now Joanne Feeney. She's portfolio manager at Advisors Capital Management, and Sonal Desai. She is chief investment officer at Franklin Templeton Fixed Income. So, Sonal, let me start with you, because bonds were very much in the spotlight this week, given what the Fed did and the reaction of the bond market. Did what the Fed say make sense to you?
Mixed, I'd say. So here's the thing. What the Fed did, I think, was a smart thing to do. It validated what the market was already pricing, which was 7 rate hikes this year. The reason I would say it's mixed is I look at the terminal rate that the Fed has, which is around 2.8, and it has inflation, core PCE, dropping from the 4 handle this year down to 2.6 next year. So you've got rates barely positive. So that part, to me, not so sure it makes so much sense. The 7 rate hikes, I mean, it was almost, I would say, a no-brainer, given that the market had already priced this. It would have been crazy for them to have missed that opportunity. I do think, actually, they've left the door open for more than 7 rate hikes this year itself. And I'm very interested, and then I'm going to stop. I'm very interested in the fact that the market really isn't pricing any rate hikes for all practical purposes after the Fed is done with this year and a little bit. So clearly the market is still not taking the Fed very seriously on this.
Joanne, what about from the equity side of it?
Yeah, it was really interesting to see the dynamics this week with the Fed coming in as expected, but, lowering their growth forecast, for example, and delivering that anticipated plan for 7 rate hikes. Equities said, okay, that's what we expected. We've already built in these kinds of rate hikes. And moreover, the Fed has just confirmed a slowing growth environment, which equity investors, I think, were expecting. And what we saw, interestingly, as you pointed out, David, at the beginning, was NASDAQ actually went up more than the S&P, showing, I think, the beginnings of a return to more growth-oriented, tech-oriented stocks, because in a slowing growth environment, broadly speaking, where are investors going to find growth? You're going to have to find the names that have secular drivers, and a lot of those are technology companies.
So now you referred to the projections for where rates are going to go, given where inflation is. How is inflation going to come down so dramatically if we don't get to positive real rates, real yields, as a practical matter? Don't you have to have the rates above where inflation is projected to be? And is the Fed really planning for that?
I would just say one thing: hope is not a strategy. And I think the Fed's forecasts, all right, their projections, and I think Joanne and I talked about this earlier, but it depends on a very rapid resumption of supply chains to some form of normalcy, because I don't think that monetary policy at this point is going to be successful in bringing core PCE, let alone headline PCE, down in the time frame the Fed is envisaging with the style of rate hikes that the Fed is planning. And yes, there is a growth slowdown. It's not. It is a slowdown, but it is not a recession. So I think that is a part of what is going on over here. That we're not. I think the Fed is trying to tread that line of not freaking the market out, and it probably clearly very successfully did that. But I do wonder whether in June, when we get the next set of SEP and dot plots, we're going to see something different. And it's going to depend critically on what we see on inflation over the next 2-3 months.
Yeah, what Sonal points out there, David, is the wide variety of projections by the FOMC members. If you look at those dot plots, unfortunately, we can't tease them apart and look at one person's projection separate from the others. But you see this incredible range. For example, some folks saying they expect the Fed fund rates to end the year at 3%, others 1.5%. And that tells you there are a lot of different assumptions and understandings of what the dynamics are this year that are going to drive inflation, growth, and rates. For example, a lot of folks are still thinking that the base effect is going to play through to lower inflation in the second half of the year. That is, we saw last year in the spring, those big price increases, and we're going to lap those. That's going to take some of the wind out of the sails of inflation. Some people must be modeling it that way. And others are recognizing that we're in a really unusual place right now for the Fed. Job openings are enormous. The firms out there are really trying to hire. So the Fed is raising rates into a pretty strong economy. And it's unlikely that firms are going to turn around and say, oh, no, the Fed is raising rates, I'm not going to hire. They see that there's still an awful lot of consumer demand out there. And the consumer remains fundamentally strong with very strong balance sheets. And even if fiscal support is running out for consumers, and even if some of them are really suffering from the high food and gas prices that are out there, enough of them are more comfortable and sitting on those balance sheets to sustain consumer demand. So it's a really tough spot for the Fed. They need to raise rates. But on the other hand, the economy is still very strong. And so we are likely to see supply come back. And so that's why I think there's such a disparity of projections that are coming out of the FOMC as to how this is actually going to play out. And trust the Fed to say, hey, we're going to be watching the data. We're going to update as we need to as the year goes by.
I couldn't agree more. So the issue of that dispersion is very real. But they always talk about the central tendency as well. And so they are, rightly or wrongly, giving some form of forward guidance via the SEP and the dot plots. But I totally accept that, because I think that, in particular, that strong labor market, we are in a very different place, aren't we? Consumers, and it's not just a strong labor market, consumers are coming into this sitting on over $2 trillion in savings. So even if we have that fiscal withdrawal, consumers still have savings to allow them to validate these price pressures to some extent. So yes, we expect some slowdown, but they can run down the stock of savings, certainly through the end of this year. And ironically, indeed, the higher inflation is probably going to bring back some more of those people who are out of the labor force back into the labor force. So I wouldn't be surprised if we saw in the months going forward the participation rate going up, but the unemployment rate also going up because of that participation rate change.
So,
it isn't a sign of weakness.
So, Joanne, that's exactly what I wanted to ask you about, because both you and Sonal have talked about the strong labor market. And we heard Jay Powell, the chairman of the Fed, say it's actually unhealthy it's so strong. At the same time, if you look at those economic projections, it says basically inflation is going to be higher, rates are going to be higher, growth is going to be less, and we will not have any increased unemployment. How can that be right? Just as a matter of basic economic theory, can those numbers all be right?
Well, again, as I think Sonal also pointed out, right, the dispersion is reduced of those projections, right? They're looking at the central tendencies, looking at the median. But within those projections, you can have wildly different individual forecasts that have, for example, inflation going up, growth going down, with higher rates. The average happens to show unemployment not changing. But if we just step back from that, how can we imagine that? So let me put on my economist hat for a second. How can we imagine that happening where rates are going up, inflation is still high, and yet unemployment doesn't go up? And I think that's where the situation is really different with the vast amount of job openings still out there, well above the number of unemployed people. Firms are really starting to hire. And as Sonal pointed out, we could very well see a higher labor participation. We may not necessarily see a higher unemployment rate, even in this rising rate and high inflation environment, just because there's such a shortage. Firms are desperately trying to fill chairs. And so we could continue to see that kind of strength. And that's why I think the Fed is really facing a really unusual challenge.
Okay, Sonal Desai of Franklin Templeton and Joanne Feeney of Advisors Capital Management will both be staying with us as we turn from what the Fed did this week to what investors should do in response. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Sonal Desai of Franklin Templeton Fixed Income and Joanne Feeney of Advisors Capital Management have stayed with us so we can talk about what investors should do with the information that they got this week. Joanne, let's start on the equity side this time. What does an equity investor take away from this? What stocks do you want to buy? Maybe not so much, given what we saw this week.
Yeah, David, it really depends what sort of equity investor you are. What are you looking for? Are you retired and you want to be conservative? Are you younger or have reason to be more aggressive? There are really very different strategies here. So if we look at sort of the more conservative, maybe income-oriented, I think you really have to think about having some defensive position, some insurance in the portfolios, because global risks are elevated and they're going to stay elevated. And it isn't just Russia and the Ukraine. It's COVID potentially. It's always other things. And so what's maybe new now is to have some insurance positions that go beyond sort of the energy, the banks, the real estate, the protection against inflation, towards some of those things that will do well if this Russia-Ukraine situation really lasts a long time. What is it hitting? Commodity prices. So you can own not necessarily the commodities, but companies that are going to do well because of those higher prices that are going to persist for a while. For example, a Caterpillar or a Rieder, which is going to see a big increase in the demand as more mining happens, right? As more countries go toward demanding food self-sufficiency, for example. So there are a lot of interesting ways to build insurance into portfolios in this kind of environment. But one shouldn't forget the reopening is still happening. And there are some reopening trades one can play if you're careful about the inflation exposure. In a growth portfolio, for example, we just added match as people go out and date more in person. We think that's a good one for folks to be involved with. And then there's the tech side. As we saw, some of the rebound has begun, and we think that's going to continue. But again, some of that is a little bit more on the aggressive side. So it really depends the sort of portfolio. We've owned these things, a lot of them for a very long time. We find it's very important to ride out the volatility in this kind of a market, but you want to make sure you're comfortable doing so.
So now, not to put too fine a point on it, but on the fixed income side, why do I want to invest in bonds right now, given the fact I know rates are going up? And if I do, which of the bonds I want to buy?
So I'd say that for one thing, there's always a place for bonds in portfolios, and certainly this is not the most attractive time to be heavily invested in long duration assets, because I certainly believe that we are going to see a steepening of the yield curve. I know that the markets are anticipating the yield curve actually inverting, which would be positive for long duration bonds eventually. But I would just note that that seems to be assuming that the Fed is going to come in, swoop in, and bail the bond market out again, the way it has every single time in the last 14 years since the global financial crisis, when the market has wobbled. So I do think that long duration assets, there will be some interesting plays there because spreads have widened. They may widen a little more. But towards the end of this cycle, certainly a lot of those long duration assets become very interesting again. But right now, I look at floating rate instruments, so I look at the bank loan space. Within high yield, we have seen spreads blow out, and certainly that allows us to go back in and find specific areas and sectors. And here I would actually say that a lot of what Joanne said from a sector perspective applies to fixed income as well, the reopening trades, looking at energy plays, etc. And the last thing I would say is when you do see commodity prices taking off the way they have, one has to remember that within the emerging market space, every country is not a loser. There are countries which actually do well when commodity prices go up, and others that do badly. And so even in that area, I would say that there are places where I would say that you can hide. Otherwise, stepping slightly outside my roundhouse, so to speak, I would say definitely it's worth looking at alternatives and from the perspective of real estate and the classic slightly stagflation-y trades, which would be commodities, real estate, places like gold, for example. And certainly, I think that you could probably do with some inflation protection in any way you can find it at this point.
Joanne, what about recession protection? Because we just heard Sonal refer to the flattening yield curve. Some people think it's going to invert, often an indication, depending on which part of the curve you're looking at, of a possible recession. Do you as an equity investor need to be taking into account the possibility of recession in your investments?
Yeah, you want to give it some probability weight. You don't want to necessarily pivot in that direction. We think it's a bit early. We're just seeing such good signs of strength in the U.S. economy. The big concern, obviously, is the war and how it might really affect Europe if it goes on for a long time. But building the portfolio, what we've done for a long time is own stocks that continue to do well even in a recession. There are some consumer staples, for example. Real estate holds up very well. And so you really do have to build that kind of insurance into portfolios as well. So it does depend on your time horizon and your goals. And, for example, in the growth portfolio, you're still going to be pretty long duration, as Sonal put it. You're going to still own these assets that are going to have a longer time to play through. And so in a recession environment or just a slowing aggregate growth environment, it's important for investors with a long enough horizon to say, well, where can I find growth? What's going to continue to grow even if there's a recession? Look at cloud computing. Look at data center expansion. This is still continuing and likely to do so through a recession. Look at software that is used for information technology infrastructure in firms. Those are the sort of companies, by the way, that are well protected from the wage inflation that may very well bedevil profits in more labor-intensive industries. And so that's a way to build in that kind of protection into a portfolio as well.
If I could just say one thing, that, to go back, and I don't want to beat this to death, but, that inverted yield curve, we need to keep in mind, the Fed owns a quarter of this market. So, it owns a quarter of this market. The yield curve is really not saying as much as perhaps we think it's saying. So that's one thing that I would note. When we look to the yield curve for signs, it is so distorted at this stage that, I would not be able to look at the yield curve. Yeah.
And Sonal, as we were talking about earlier, the nominal rate yield curve, you look at the 210 or, whichever, that's getting very flat. It may very well invert, which kind of makes sense because we have high near-term inflation and much lower projections for inflation 10 years from now. So interest rates near-term should be a lot higher, right, than interest rates longer-term. But if you pull out inflation, right, the real interest rate yield curve is actually pretty healthy looking. And it's the real interest rate yield curve that should be telling us more about real growth projections. And so there isn't as negative a signal coming from there. And I think that's what we're seeing in the strength of consumer, firms hiring, GDP growth expected still to be well above long-term trends this year and next.
I would just add to that. If you look at real yield curves as well, if I look at inflation linkers, that's another market the Fed owns. So, it owns, again, a quarter of that market. So I tend to be a little bit more skeptical about the inflation signals, the duration of inflation expectations. I would just note that as we come to fall, if what we anticipate happens and people have seen 7 to 8% inflation for an extended or protracted period of time, the idea or the risks of a wage price spiral become far more serious. And that means that inflation might hold on for longer than the Fed would like, or indeed any of us would like in the market, because that's not a healthy environment for any stocks or bonds. So
yeah.
We've made it to the end of this discussion without a lot of discussion about the war. So, Joanne, I'm going to give you the hardest job. Just briefly at the end, the markets seem to be looking past Ukraine right now. Are they premature, or are they onto something?
Well, when we look back at the markets and various wars and disruptions, recessions, pandemics, we do see that investors tend to recognize that wars tend to be temporary disruptions. I think there may be reason to believe that the risks associated with this situation are more elevated, but they're in the tail still. And so I think investors are recognizing that the disruption, even if bad, is likely to be mostly focused on Europe than here in the U.S.
Well done, Joanne. You landed it, that hard assignment. Thanks so much to Sonal Desai of Franklin Templeton Fixed Income, and also Joanne Feeney of Advisors Capital Management. Coming up, we take a look at the week ahead around the world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We look ahead now to what's coming up next week on Global Wall Street, starting with Juliet Sally in Singapore.
Well, thanks, David. China's economy remains in focus for investors as COVID lockdowns and risks from the Russia-Ukraine war put further pressure on the need for further stimulus. However, China's loan prime rates for March will likely remain unchanged for a second straight month after banks lowered their quotes in January. Elsewhere, we get key earnings across sectors from tech to autos to banks. Investors will be waiting for Beijing to follow up on its vow to stabilise China's markets with tangible actions. Now over to Danny Berger in London. Danny?
Thanks, Juliet. The war in Ukraine continues to be the focus for Europe in the coming week. Any talks between Ukraine and Russia will be closely watched, as well as the continued shelling of Ukrainian cities. We're now looking at refugee numbers of people who have left Ukraine surpassing 3 million people. The international response will also be closely watched, with the U.S. pledging new weaponry and at the same time European countries stepping up their defense spending. Now over to Romain Bostic in New York.
Thanks, Danny. After the Federal Reserve lifted interest rates and signaled hikes at all remaining meetings this year, we're going to hear again from Chair Jerome Powell next week. He speaks at the 38th Annual Policy Conference of the National Association for Business Economics on Monday. Economic data next week include new home sales, University of Michigan sentiment data, and durable goods orders. Durable goods, which have increased in 19 of the past 21 months, they're expected to have fallen in February for the first time since September. And a small handful of earnings to watch next week, including Adobe, Carnival, General Mills, Darden, and Nike. Nike may be of keen importance to the broader market as equity investors have shifted focus from supply chain concerns to whether strength in consumer spending can sustain the economy in the face of higher interest rates. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, inflation, Fed tightening, and a war in Ukraine. They've roiled the markets, so what's a central bank to do? We hear from Rick Rieder of BlackRock. That's next on Wall Street Week on Bloomberg. February 24 marked the invasion of Ukraine by Russia.
Putin started a war with Ukraine, with the democratic world,
changing the lives of millions of Ukrainians.
Civilian targets have been hit again last night. The emergency services in the capital city in Kiev have also been reporting hits on residential buildings.
And resonating through economies around the world as the United States and its allies move decisively to impose a wide range of economic sanctions.
We are enforcing the most significant package of economic sanctions in history, and it's causing significant damage to Russia's economy.
But the world was already changing before Russian troops came across the border with Ukraine, with concerns over inflation higher than they've been in 40 years.
We're not going to let high inflation become entrenched. The costs of that would be too high.
And ongoing problems with the supply chain triggered by a pandemic that touched every corner of the global economy.
It's just another headwind and a ripple through supply chains that are already very stressed. We had seen some nascent signs of improvement in the supply chains, but you had seen that at year-end and going into early this year. But I think all of this really gets reversed because of the war.
All of which poses a unique set of challenges for central banks like the Fed that have to respond to multiple crises when they are very close to the zero bound with their interest rates.
We are starting this Fed episode at the lower bound, as you mentioned. The last time inflation was like this was actually July of 1978. It was just under 8%, but short rates at that point were 8%, and the 10-year was just above 8%.
To take us through what the Fed is confronting, we welcome back now Rick Rieder, BlackRock's CIO of Global Fixed Income and head of the Global Allocation Investment Team. Rick, great to have you back with us on Wall Street Week. So as we just said, the Fed had a hard job before the war came up. There are a lot of problems there. Now they got the war on top of it. In a nutshell, it's a favorite game. How are they doing?
David, listen, and I think Chair Powell alluded to the fact that they should have moved earlier. We're in it. The Fed is behind the curve, significantly behind the curve. Now I think what's really tricky is how do you move to the other side quickly and not disrupt the system so aggressively? So I think they're in a tough spot. In fact, I think this is the toughest spot I've seen a Fed in, maybe in my career. And so listen, I think it's going to be a challenge. I think you've got an economy that, I always say this, high prices are the cure for high prices. You're actually seeing an economy that's starting to moderate in a number of places. And I think the Fed has to try and be careful about not letting the economy slip into a recession while they're trying to deal with inflation. Listen, much of this inflation is supply shock driven. When you go through some of these, we talk about energy a lot. The global wheat production, 34% comes from Russia to Ukraine. Pretty incredible numbers. You're going to see that flow through of food prices. So it's a challenging dynamic that's going to impact the economy for sure. And the Fed's got to straddle a very fine line.
So as you say, Rick, high prices are said to be the solution for high prices. I'm going to put up a chart here for our television audience. We'll describe it for those of us joining us on radio. That basically illustrates that point in terms of real consumption, not nominal consumption, but real consumption, and the extent to which really inflation at this point is outpacing the growth in consumption.
It's pretty incredible, David. We went through this period, with an explosive set of real growth of quantities, real growth of goods demand that as you emerge from the pandemic, people are buying cars and furniture, et cetera, across the board, electronics, computers, et cetera. Then now you get this spike higher in prices. And what you're seeing is a pretty extraordinary dynamic that now real consumption is starting to come off, i.e., the cure for high prices, people start to pull back on demand. You're seeing this in inventory builds. Retailers are growing in terms of, you're seeing inventory start to build. That will bring prices down. But it's definitely something to pay attention to. I think I have one other chart that shows the dynamic that where we are today in consumer sentiment. Consumer sentiment's the lowest it's been in 10 years. Desire, a good time to buy a car, a house, durables, are really falling precipitously. So, this is part of that dynamic that the Fed has got to straddle this line, and the consumers are going to pull back. Look at these numbers. It's pretty staggering. By the way, you're talking about these numbers falling off a cliff when the consumer is arguably in the best shape I've ever seen them in history. Savings rate is up, wages are up, hiring is up, and yet they're going to pull back and they're going to wait because these prices are eye-popping high and are going to wait for a better period of time. Particularly when you look at the consumption basket for lower and middle income, fuel and food shelter where you're seeing the biggest price hikes. It makes it really tough for consumption to stay up.
I want to come back to the lower and middle income, but before that, just interpret that conditions chart for me just a little bit, Rick. Is that demand destruction we're starting to see?
That's exactly right. I mean, it's literally the dynamic. By the way, you're seeing this in corporate earnings. It's interesting. You see a lot of companies now, and they're reporting their revenues are still decent. But then when you actually dissect their revenues, and you get a dynamic where, wow, they're not getting it from quantity anymore. They're getting it from price. There's a limit to how much you're going to get that. And this is part of why earnings can start to come off over the next couple of years, because you can't keep getting it through price. You got to get it through quantity as well. By the way, when you look at what the Fed did in terms of their projections this week, they dramatically brought down real GDP. And they dramatically brought up inflation. Listen, that is something that will, the economy, the U.S. economy particularly, is the most flexible, self-calibrating economy in the world. And I think you're going to see that. You're starting to see that transmission through the economy today.
And yet, as you point out, there may be some good news in here that some of the middle and lower income people are gaining the most right now.
So, I mean, this is, I think it's a very easy answer. And quite frankly, I don't think it's a complete answer when people say, gosh, the Fed's just got to keep raising rates and do it quickly. You got to be really careful. If you think about what's happened the last few years, wages are moving up. You're bringing more people into the labor force. By the way, there's 2 million or so less people in the labor force today than pre-COVID. You need to keep cultivating that. And this is where I think when you look at this chart, I mean, look at how well lower and middle income is doing now. You're seeing explosive wage growth and people coming into the workforce. That is something the Fed wants to keep going. And particularly think about the income burden in this country, or I should say the debt burden in this country. And we're going to have to fund an awful lot of debt over the coming years. Fed's got to be really careful. A, if you lift interest rates too much, that debt burden is going to be too high. And B, you want to keep lower and middle income wages up and keep bringing people into the labor force. So I just don't think it's as easy as some people say. It's like, we got to get rates up. We got to get them up quickly. We got to reduce the balance sheet quickly. I think we're far from neutral. Fed needs to move away from easy policy, which is, I mean, think about the irony. QE was happening last week, and now we're going the other side. They've got to move quickly away from that. But I just think projecting out where we're going to be 6 months hence on the economy, I just don't think that that's as easy as people suggest it is.
So, Rick, you're responsible for investing an awful lot of money there at BlackRock. I have to ask you, how are you taking into account, if at all, the war in Ukraine? Because it looked to me this week like the markets almost said, well, we're going to react for a while, but sort of we're over it. We're back to saying it's business as usual.
So, Dave, first of all, I would say this is the most extraordinary weeks in markets I've ever seen. I mean, so by the way, the news, not as the Ukrainian news, you had a more hawkish Fed, and then the markets just, I mean, particularly the equity market, just went right through it. Now, some of it is rates stabilized. That was a big deal. Part of it is people have been sitting on the sideline. The losses have been significant this year, both in bonds and stocks. So people were on the sidelines. They're sitting on a lot of cash. And then, you started, okay, maybe I can start to put some money to work. And that started to build on itself. And listen, there was one significant piece of news this week that should not be underestimated. China, the world's watching how China is going to align with Russia or not. And there were some significant statements, both on the regulatory side, on the growth side, but also somewhat what clearly appears to be some detaching between China and Russia. And that was one of the things the markets were super concerned about, because that creates a framework that's really hard to deal with.
Bless your brother for raising it, because the other question I had was China, because some people think that maybe President Xi capitulated when it comes to some of the regulation on big tech and some of the issues with really seeking investors from outside of China.
Yeah, I mean, listen, it was a pretty strong set of statements. I mean, I was actually blown away by how aggressive these statements were. I think there's a couple things to talk about here. One, right. Chinese economy has been slow, right. and you have the lockdown in some of the cities, Shenzhen, et cetera. Right. That has created some concern. And then, right. A lot of pressure, immense pressure on some of the markets there. So, Listen, I thought it was a pretty strong statement. And I think that's part of what the markets latched onto this week.
Yeah, when Rick Rieder says it's one of the most extraordinary weeks in markets, you have to listen to him. Rick, it's always so great to have you here in Wall Street Week. That is Rick Rieder, of course, of BlackRock.
Thanks, David. Thank you.
Coming up, special contributor Larry Summers wraps up the week for us. That's next on Wall Street Week on Bloomberg. Wall Street Week. I'm David Weston. We welcome back once again our very special contributor, Larry Summers of Harvard, to help us wrap up this week. So, Larry, you've been calling for quite some time on this program and elsewhere for the Fed to really wake up, smell the coffee, and realize we need to be focusing on inflation. We need to increase interest rates. They took a big step in that direction this week. Was it enough?
They did, and I was glad to see it. I think they're recognizing that they're behind the curve. I think they've still got a long way to go. They've got a long way to go in forecasting realistically. I just don't believe that it is plausible that we're going to have 3 years of 3.5% unemployment while inflation falls precipitously. Nor do I believe that inflation is likely to fall precipitously on a path where the nominal interest rate never gets within 2 percentage points of where the inflation rate is right now, not at any point in the next 3 years. I also think that the Fed needs to recognize that its 2020 framework was perhaps a good idea in the deflationary context of that moment, though I'm not sure it was, but it is surely not got anything connected with our current kinds of challenges. So perhaps institutions adjust with some gradualism, so perhaps we're moving in the right direction, but I think there's a long way to go, and I don't think the Fed has really done all that will be necessary to preserve its credibility in the face of the substantial inflation that I think is likely to come to us in recent months. You know, I just had a chance to review what is the best data on wages, the data from the Atlanta Fed. And depending on which of the indices you use, how you weight the data and so forth, on some measures, wage inflation is now getting close to 7%. And that is just not consistent with the kind of places that we want to go in terms of inflation.
So, Laurie, to focus very specifically on inflation, which you've been asking us to do now, as I say, for over a year, if you take a reasonable projection of inflation out over the next year, 2 years, what kind of Fed funds rate do we need to get it down? I mean, clearly, we need to get into a positive real yield number. And what do you need to get the rates to be in order to really have the rates be higher than the inflation rate?
Here's the problem with FedThink, David. They assume 2% long-term inflation, and then they say that the neutral rate is 2.4, and then they say, look, we're going to raise rates to 2.7, so we're going to be above the neutral rate, so aren't we great? But the problem is that that whole calculation is based on the assumption that we're going to get inflation down to 2, and they don't provide a basis for believing that. A simpler and more direct way to think about it is to say that when inflation goes up, if you just raise interest rates as much as inflation went up, then you're not changing real interest rates at all. If you want to tighten policy, you have to raise interest rates by more than inflation went up. We used to be a 2% inflation country. Now we're almost certainly a 6% inflation country, and on some measures we're an 8% inflation country. And so we've got to raise interest rates by more than 4 percentage points. We've got to raise them by 4% to stay neutral. And we probably have to raise them more than that. So I think ultimately we're going to need a 4 or 5% interest rates, levels they're not even thinking of as conceivable. Now, the reason for this is that they believe, as do many, to be fair to them, in the markets, that the main problem with Team Transitory was the marketing, not the reality. So they think inflation is going to come way down without any action on their part to bring it down. Maybe, I see rental inflation, which is 40% of the core CPI, is likely to rise substantially this year. I see more bottlenecks coming as China gets into very substantial lockdown. I read a story this morning about airline prices really taking off as people start to travel again. There are numbers suggesting low medical care inflation prices, but every hospital in the country is desperately short on nurses and other medical personnel. So I don't think we can count on the transitory inflation view, and I don't think we can count on the restraint they're providing, because by the standard measures, they're not meeting the test of providing any restraint on their path. And that's why I think we have a long way to go.
One of the things that certainly people at the pump are feeling right now is the price of gas. And we had the president this week weigh in a tweet, actually really saying, wait a second, the price of oil at that point was down to $96 a barrel. Last time it was there, it was only like $3.30 at the pump. Now it's $4.40. It must be that the oil companies are padding their profits. How about that economic analysis?
You know, I wish the president got more help from his economic advisors. Those spreads between gasoline prices and refined prices vary substantially on a range of factors. There's lags between the price of oil and the price of gasoline. When natural gas is in short supply, when diesel is in desperately short supply, it affects the mix of products that refiners provide in ways that change that spread. Maybe there is a basis for thinking that profits are being padded, but there's nothing that would support that in the president's tweet, and I haven't seen any analysis coming out of the administration or any place else that provided serious support for that. Look, at a time when we have a war to fight, at a time when energy security is a central issue for us, at a time when over time we're going to have to cooperate with our energy companies on the necessary transition away from fossil fuels, I think we should be very careful about accusing them of bad behavior unless we've got clear evidence. Now, the administration may have clear evidence, and if so, I'll be the first to admit that and to want to look and evaluate the evidence. But this kind of comparison that was contained in the president's tweet, I'm afraid, does not represent that kind of clear evidence.
Larry, let me pick up on your reference to the war, because this week, certainly, we did not see a conclusion to that war, quite the opposite in many respects. At the same time, we're trying to bring in China, at least keep them neutral, or maybe come in on the United States side to discourage Russia. If you can, take a look forward. When this war ends, it will at some point. What does the world look like in that world? Some people I've heard say, look, we're moving from a world of globalization and cooperation into the rivalry of great powers like the late 19th century.
I don't know the answer to that. I'm not sure anybody does. It demands very large amounts of very hard, and I think it will often be painful thought. What I would hope that we would recognize is that we would bring a kind of tragic realism to this. And we may be right about all that is evil and wrong in China, in Saudi Arabia, in Iran, in Russia, in other countries. On the other hand, we need to make our way in the world, and I'm not sure a posture of outrage towards all the other countries in the world that have substantial leverage, or even towards a large fraction of those countries, is going to be a viable strategy for us. From my perspective, the central challenge as we go forward in the world is finding a way for the United States and China to mutually accommodate each other, not necessarily to be friends, but to have respect for each other. That's what I believe ultimately our success depends on, and ultimately the stability of the world depends on. And I think as we carry on all of our other relationships, we need to maintain a strong awareness of that central reality.
Larry, that's so terribly helpful. Thank you very much. That's Larry Summers, our special contributor here at Wall Street Week. He, of course, of Harvard University. Coming up, when a single sign can cut through the fog of war. This is Wall Street Week on Bloomberg. Finally, one more thought. Cutting through the fog of war. The Prussian military strategist Clausewitz wrote of war being the realm of uncertainty, where 3/4 of the bases for actions were wrapped in a fog of uncertainty. And the war in Ukraine is certainly no exception to that, with Russia claiming the United States has secret chemical weapons in Ukraine, something NATO Secretary General Jens Stoltenberg terms absurd.
They are making absurd claims about biological labs and chemical weapons in Ukraine. This is just another lie.
And we get wildly differing accounts of the losses being suffered.
There still are some really, really severe images of people being killed, of shelling, of residential areas getting bombed. And how much do you see that fear in the Eastern European nations that feel incredibly vulnerable?
They continue destroying our cities, killing our children, civilians. And it speaks for one fact only, that even if we continue talking with Russia, that does not have an impact on the behavior of Russian army on the ground.
The accusation about the shelling of the infamous maternity hospital in Mariupol and the shelling of the Mariupol theater and the fact that Russia is not allowing refugees to leave Ukraine, all these fakes have been refuted many times.
At one point, Russian Foreign Minister Lavrov even denied that Russia had invaded Ukraine in the first place.
We're not planning to attack other countries. We did not attack Ukraine.
And it certainly doesn't help that Russia has made any so-called fake war report a crime, driving Western journalists from the country.
The media from outside of Russia has a difficult time penetrating audiences and getting in.
But even in the fog of war, sometimes a ray of sunshine makes it through. And that's what happened this week on live Russian TV, when a news producer named Marina Ovsyannikova burst onto the set in the middle of an evening newscast on one of the state-controlled broadcasts, holding up a sign condemning the war and saying simply, по-русски, «Здесь вам врут». They are lying to you. She was promptly arrested, interrogated, charged, and fined the equivalent of $280, at least so far. So at least sometimes, in some places, it appears that the truth can conquer even the fog of war. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.